Hello, and welcome to the Semiconductor Industries Association's public webinar series, where we address current issues impacting the global semiconductor industry and market. My name is Falani Nug, and I am the Director for Industry Statistics and Economic Policy at SIA, and I'll be the host and moderator for today's webinar. The past year has been one for the ages for the semiconductor industry and market. With the world still gripped by the COVID-19 pandemic, semiconductor-enabled technologies have allowed the world to remotely work, study, treat illness, and stay connected. At the same time, COVID-19 has shifted global semiconductor demand in unprecedented and unanticipated ways that has disrupted global supply chains and contributed to a widespread global semiconductor shortage. The US government and other governments around the world have taken notice of the importance of semiconductors and have or are contemplating policies to incentivize increased chip production and innovation. A new SIA report tries to put this past year in perspective, as well as seeks to show how the US semiconductor industry has weathered the storm's global position across a variety of metrics, including market share, manufacturing, and technology competitiveness. The 2021 State of the US Semiconductor Industry Report demonstrates that while the US industry has faced unprecedented challenges over the past year, it also has an historic opportunity to improve upon its current leadership position in the global industry. We are fortunate to be joined today by a group of distinguished panelists for a conversation about the year we have just experienced, the challenges and opportunities facing our industry, and what the future may hold. Mr. John Pitzer is a managing director, global technology strategist, technology sector head, and semiconductor analyst at Credit Suisse. Mr. Pitzer joined Credit Suisse in 2000 and has maintained a top 3 analyst ranking in external polls, including Institutional Investor, Greenwich Survey, and Bloomberg. Prior to joining Credit Suisse, Mr. Pitzer also held analyst positions at Prudential Volpe Technology Group, Deutsche Bank, Alex Brown, and Needham & Company. Welcome, John, and thanks for joining us today. Mr. Dan Hutchinson is CEO and chairman of VLSI Research. He is a recognized authority on the semiconductor industry, winning SEMI's Sales and Marketing Excellence Award in 2012 for empowering executives and tremendous strategic and tactical market value through his e-letter, The Chip Insider, his book Maxims of High Tech, and his many interviews of executives. Welcome to you, Dan. Finally, Dale Ford is chief analyst at the Electronics Components Industry Association, or ECIA. Previously, Dale managed the research teams at IHS responsible for coverage of the electronics, semiconductor, and electronics components industry, and was one of the founders of iSupply's market research. As a highly respected industry analyst with extensive experience producing award-winning market research, he brings expertise in technology, trends, competitive analysis, forecasting, and supply-demand research of the electronics, semiconductor, and electronics components industries. Mr. Ford has been researching the electronics and electronics components industries for over 25 years. Welcome to you, Dale. Before we turn to our panelists for their opening remarks, I want to take just a few minutes to provide an overview of the recently released State of the Industry report. This report, which just came out last week, is available at SIA's website, www.semiconductors.org, for complimentary download. Now, it's impossible to talk about this year in semiconductors without talking about the pandemic. And really, what the report helps to underscore is that throughout the various stages of the pandemic, whether it was issues with trying to maintain fab manufacturing or supply chain disruptions, or even trying to improve and get technology, the pandemic vaccines developed, the semiconductors have proven essential throughout the world in trying to help move the world through the pandemic. Of course, this, in terms of you and I, probably is most directly evidenced in our virtual world that we're using now. Using Zoom and work from home, school from home, play from home. All those new shifts in the way the world has operated has been enabled by semiconductors. Now, one thing we've also read a lot about and experienced over this past year has been the global chip shortage, and the industry's response to it has been to do as much as it can in the short term to increase capacity utilization. And really, that's sort of the main way that the industry has to address any short-term supply issues or increase in demand. This chart here shows that over the past several quarters starting in mid-2019, but certainly ramping up in 2020 and 2021. Fab capacity utilization globally has run well over 80%, and in some quarters most quarters over the past year, well over 95%, which really is quite amazing. And quite frankly, it's not a sustainable business model to run fabs at that high level. But it's what the industry can do and has been doing in the short term to address the unprecedented and very high historic increase in demand that we've experienced over the past year. Now, of course, on the policy side, I mentioned many governments, including the US government, are contemplating incentives to help increase the fab and manufacturing footprint in the United States. And this chart here shows you what has been going on in terms of fab capacity share in the US over the past decades. And really where we're at now is 12% of total global fab capacity is located in the United States. And if nothing changes, that is going to continue to decrease to about 10% by 2030, while fab capacity utilization, while fab capacity share in Asia will continue to increase. Now, when we look at how the market performed in 2020 and certainly through most of 2021, it was very uncertain at the beginning of 2020 when the pandemic hit how the market would perform. Luckily, and as we've seen, the market actually grew and helped to get us through the pandemic, as I mentioned earlier, with increased sales for such products as memory and logic to help with Zoom and other sorts of moving to our remote world. So at the end of 2020, the market actually grew by almost 7% year over year. And what we're looking at in 2021 is an increase in sales without a doubt, probably along the lines of 20 to 25%. WSTS recent forecast back in the spring had sales increasing by about between 19 and 20% year over year from 2020. But I imagine their updated forecast that will come out at the end of November, beginning of December, will probably be higher than that. In fact, I think we're well on our way to having a 500 billion plus market for 2021, which would be the first time ever that the industry has produced sales over 500 billion. Now, in terms of the US industry market share, the US has maintained global market share, sales market share annually for the past 20 years or so of around 50%, has been the sales market share leader for US headquartered companies. And this has really enabled the industry to maintain sort of continued leadership by taking advantage of sort of the virtuous cycle that the graphic on the right helps to explain. Basically, with high sales, the industry can reinvest high levels of sales back into R&D. And as most folks may know, the semiconductor industry is highly R&D intensive. It's one of the most R&D intensive industries in the United States, in the world, in fact. And the US semiconductor industry typically invests higher levels of R&D as a percent of sales back into its industry than other countries' industries, other countries' semiconductor industries. So this helps ensure that long-term and medium-term leadership in terms of innovation, but it all begins with sales leadership and having high levels of sales market share so that you can reinvest those high levels of sales back into R&D. As I mentioned before, the US semiconductor industry leads other semiconductor industries in terms of the rate at which it reinvests in its sales back into R&D. 18.6% was the rate in 2020, and that was higher than all other countries' semiconductor industries. And this again helps to ensure long-term and medium-term leadership in terms of innovation and sales going forward. Just want to highlight one other component of the report. We look at what the domestic workforce footprint looks like in the United States. This was in some work that we did with Oxford Economics in a report that's on our website. But basically, the US domestic workforce for semiconductors is around 277 direct jobs. But more importantly, those direct jobs have a very high employment multiplier of about 5.7%. So basically, for every one job in the United States in the semiconductor industry, that translates to another additional 5.7 jobs within the US economy. And that's both upstream in terms of jobs created through industries that help supply materials and equipment to the semiconductor industry, as well as the downstream respending that semiconductor industry employees engage in and help create other jobs downstream. So in total, we're talking about close to 1.6 additional jobs, but when you add in the direct jobs, we're getting closer to 1.8, between 1.8 and 1.9 total million jobs in the United States. So the question is, what should the U.S. do to maintain its leadership and to help in some areas where, as we noted earlier, and as noted in the report, where the U.S. is falling behind in terms of manufacturing footprint? Well, first, investing in U.S. semiconductor leadership is fundamental, and this includes a couple of things. One, importance to fund the domestic semiconductor manufacturing, research, and design provisions in the CHIPS for America Act. Two, enact an investment tax credit encompassing both manufacturing and design to spur the construction of new onshore advanced semiconductor research, design, and manufacturing facilities, and to promote domestic chip innovation. Number two, strengthen America's technology workforce. And this is really done in two ways. First, implement a national strategy backed by appropriate investments and in consultation with education leaders and the private sector to improve our education system and increase the number of Americans graduating in STEM fields. And two, reform America's high-skilled immigration system to enable access to and retention of the best and brightest in the United States. Number three, promote free trade and protect IP. Approve and modernize free trade agreements that remove market barriers, protect IP, and enable fair competition. And two, expand the Information Technology Agreement, one of the World Trade Organization's most successful free trade agreement. And of course, this is all very important because not only are semiconductors made using a global supply chain, but over 80% of all US semiconductor industry sales occur outside the United States. So the industry is truly global, both in how it manufactures its chips and in terms of where it sells its chips. And four, cooperate closely with like-minded economies. Recognizing the global nature of the semiconductor industry, it's important to expand collaboration with like-minded allies in shaping a regulatory and legal environment more conducive to growth, innovation, and supply chains resilience in such areas as regulatory coherence, standards, and export controls. By implementing these policies, Congress and the administration can take key steps to protect American leadership in semiconductor technology and win the global competition for technologies of the future. So that sort of encapsulates what the report includes. And now I want to turn it over to our speakers, starting with you, John Pitzer, to give you an opportunity to provide remarks on what we've gone through this past year and how you see the industry and market playing out for the foreseeable future.
Yeah, thanks, Milan. Along with Dan and Dale, I'd like to thank everyone for joining us this morning / this afternoon for this webinar. It's always a pleasure to present with the SIA. Milan, if you could open up my presentation, that would be helpful to kind of go through the slides.
Yep.
Perfect. And so if you can go forward a couple slides right here, the first thing I want to just talk about is how I think about the world, to give you kind of a sense of our analytical framework, and whether this is looking at the semi industry overall or any one of the companies that live in the semiconductor ecosystem. There's really always 5 things I try to go after. What's the secular view, which is sort of what's happening over the next 3 to 5 years? What's the cyclical view, kind of a 1 to 2 year time frame, seasonal, product cycle? And because I do deal with public markets, I always have to throw valuation in there. What I wanted to try to do this morning is really hit upon our secular view and touch a little bit on the cyclical as well within that. If you could move forward one slide, follow. And so the key message here on the secular is really we're making the argument that after 20 years of actually not capturing value relative to the global economy, the semi industry is now positioned to start to outgrow nominal global GDP again on a very consistent basis. And if we're right, what we think that means numerically is what has been a 3 to 5% revenue CAGR for the industry is poised to accelerate to at least 6 to 8, with optionality really to 9 to 12. And I'll walk you through kind of the argument which starts on the next slide. One more, please. So the first thing you have to recognize is from really the late 90s until about 2015, 2016, your industry actually did a horrible job capturing value. And the way we look at that is semiconductor revenue as a percent of global nominal GDP, which is really the chart on the upper right quadrant of this slide. And what you can see is from the beginning of semi time until the late 90s, this industry consistently captured value by outgrowing nominal GDP. At the start of the late 90s, that kind of reversed. And in fact, if you look, despite the fact that semiconductors are significantly more pervasive across the economy today than they were 20 years ago, as a percent of nominal GDP, semi's value is down about 15 to 20%. And there were a couple of reasons behind that. If you could fast forward, Falon, to the next slide. What we're arguing really is in the late 90s, three things happened to kind of move semis from consistently capturing value to actually losing value. And those three things were very simple. Bearish entry came down, supply growth accelerated, and end demand became much more dependent upon the consumer. And what we're really arguing is now all three of those dynamics are reversing. And I'll go through quickly over the next couple of slides, each one. So if you could forward to the next slide, please, Plum. Relative to bearish entry, what I would argue is that in the late 90s, the advent of the foundry model in general and TSMC specifically dramatically reduced the barrier to entry to the semiconductor industry. Prior to the foundry model, the biggest fixed cost burden in the industry was CapEx. You had to be big enough to justify building a fab to fill it. Once that happened, when the foundry model came into being, TSMC really took that CapEx burden off the table. It meant that if you were a small company with a good design, you could ship it off to Taiwan and they could manufacture it for you. And what you saw as a result, as bearish entry came down, new company formation dramatically accelerated in the space. Many of the sort of the fabless IPOs that occurred in the semiconductor industry occurred in that sort of mid 90s to early 2000 period as these bearish entry came down. As you start fast forwarding to 2008, 9, 10, really after the financial crisis, kind of an interesting thing happened in the semiconductor industry. The industry started spending more on R&D than CapEx. And as a result, even if you were fabless, you had to be big in order to support being in this industry. And what that drove was massive consolidation. I think a key thing that's going on cyclically right now and also structurally is that since the financial crisis, there's been 250 mergers and acquisitions in this space. There are fewer companies today that can do this than 5 years ago, and there's likely to be fewer companies 5 years from now. And I think that's an important dynamic because as bearish entry went up, this industry rationalized very significantly. One of the reasons why we're in sort of the tight supply situation we are today is typically at the bottom of a cycle when semi customers are destocking inventory. Semi companies are forced to underutilize existing capacity because no one wants to produce more than their customers need, such that when the cycle turns, there's usually a lot of underutilized existing capacity out there, which is relatively easy to re-ramp. It takes 3 to 4 months to re-ramp existing capacity. It takes anywhere from 12 to 24 months to build brand new capacity. What we've seen with all this M&A is as company A bought company B, they did one of two things. They either rationalized fabs internally or they outsourced more to the foundries over time, such that we didn't have that pool of underutilized capacity at the bottom of this cycle. And one of the reasons why we think that this has been a stronger for longer upturn is we're just much more dependent on building brand new capacity for supply to catch up to demand. If you go forward to the next slide, please, Vaughn. The other thing that we're arguing is that in the late 90s, supply growth started to accelerate upon multiple vectors. Moore's law became a little easier, and the advent of 300 millimeter was just a much more productive wafer size transition than I think the industry realized. And we went through a multi-year period of just too much capacity in the industry. What's interesting to me is 450 millimeter R&D, which really took place in 2008, never really materialized into productive capacity, which should have happened in 2010. And without the move to 450, all the productivity gains that we've seen at 300 millimeter have kind of played out. And supply growth is now structurally slowing. It just costs more to add capacity. I think one of the more interesting dynamics that doesn't get talked about enough is we are in perhaps the tightest supply situation cyclically the industry has ever seen. That's despite the fact that over the last 5 years, CapEx and WFE has almost doubled over that 5-year period. So it's not as if we haven't been growing CapEx and WFE. The issue is the cost of adding capacity is just going up. And without the move to the next larger wafer size, we think that's a relatively permanent trend. Next slide, if you look at the demand curve, the industry, prior to the late 90s was really about enterprise demand. It wasn't until kind of 1997, 98, when we had to move to the sub $1,000 PC to drive demand, that the demand curve became much more consumerized. That was accelerated and put on steroids with the move to the mobile phenomenon in the early 2000s. And that was a very sort of price sensitive market. And what happened is as bearish entry came down and supply growth accelerated and the demand curve became much more consumerized, management teams, drove price elasticity to try to drive growth. I think one of the biggest sort of misconceptions in the semi industry is this idea that Moore's law dictates that this is a naturally price deflationary industry. It's not. It's a naturally cost deflationary industry. And if you actually look at the data over time, from the late 60s to the late 90s, average selling pricing went up by about 3 to 5% on a very consistent basis. It wasn't until the end of the 90s that we lost that pricing power. And to be clear, it wasn't as if semi companies were raising like for like pricing. What was really going on is as the semi industry worked on bringing down the cost per transistor, the software ecosystem was coming up with applications that was driving demand for transistors up at a faster rate than the cost per transistor was going down. And when that happens, you have a natural price increase every year in semis. That dynamic fell apart at the end of the 90s. What's great now is you're starting to see either the cloudification of the market or a move to end demand drivers that are less price oriented, whether that be in the auto market and in the industrial market. And one of the things we show on the lower right side, which I think is an important slide, is today there are three sub-markets in semis, each of which are slightly below 10% of the market: autos, industrial, and data center. And we think between now and the end of the decade, each one of those has the ability to double as a percent of semiconductor share. And so those are very high growth, highly prized markets that tend to be less price sensitive. We think that semis are in the early stages of regaining some pricing power secularly. And if we're right, we think that that's what drives the growth rate from 3 to 5% CAGR up to 6 to 8, with a potential CAGR, which I talk about on the next slide. Very quickly, this is the data economy. And if you think about, demand curves across technology, the umbrella demand curve is data and data growth. And one of the things that we've been arguing now for 7 or 8 years is that as I think about semiconductors and data, we tend to think about 4 buckets. You've got to create it, you've got to store it, you've got to move it across the network, and you've got to analyze it. And I think this is a very consensus view today. One of the things I think people miss, if you can fast forward one more, Falon, on the slides, is that the first 3 buckets of creation, storage, move across the network have all benefited from nonlinear cost declines during the digital age. Moore's law tells you every year it's cheaper to make a bit. There's a Moore's law equivalent in storage called Kreider's law. There's one in networking called Butter's law. And as the cost to doing something came down, there were people much smarter than me that came up with brand new use cases that always grew the market to be significantly larger than people ever thought at inception. In my mind, that's how technology works. Half the ecosystem works on bringing down the cost of doing something. The other half of the ecosystem figures out new use cases. My favorite example, because it's a little bit non-intuitive, but talks directly to this, is ride sharing. I mean, if you think about Lyft and Uber, those business models could not have existed in a 3G world because the cost of moving that data across the network was prohibitive. We moved from 3G to 4G, you bring down the cost of moving data, and all of a sudden new business models spring up. The point that we're keep trying to make is that this analytics bucket, which is clearly the most important buckets, because if you can't analyze data, you can't monetize it, has mostly only ever seen costs go up during this time period. And the reason for that is most of the data the world makes is messy, it's unstructured, And in order to get something out of it, you've had to kind of clean it up and structure it. And that move from unstructured to structured is very timely and very costly. What we find interesting about AI and our hypothesis around AI and machine learning is it promises to be the first technology that can systematically lower the cost of doing analytics. And the leap of faith that we're willing to make if that happens is that people a lot smarter than me are going to come up with brand new use cases to use that declining cost curve. And it's a big potential TAM because today, while data has been growing at a 50% CAGR for 20 years, we're analyzing less than 2% of the data we create. And one of the thought exercises that we keep going through is what happens to the amount of compute power and semiconductor demand that we need if that 2% moves to 4%, moves to 8%, moves to 16%. And our view is that it's more than a linear growth curve. And it's really our basis as to why we think this industry has the opportunity to be $1 trillion industry by the end of the decade. That would represent about a 7% CAGR from here. And it's our view that the pace at which we move to the truly data economy could add sort of 100 to 300 basis points to that 6 to 8% CAGR that we talked about earlier, which is how we get optionality to sort of 9 to 12. Now, the last point I'll make before turning it over to Dan is the most common question I get near term is where are we in the cycle? And the way that we think about the semiconductor cycle and how we gauge where we are is really we try to look at semiconductor unit shipments versus long-term trend. The idea being that semiconductor cycles are defined by inventory cycles. When semiconductor units are well below trend line growth, that's sort of the period of destocking and the bottom of the cycle. When semiconductor units are above trend line growth, that's the period of restocking and the top of the cycle. And based upon that data, this cycle bottomed in June of 2020. We bottomed about 22% below trend line unit growth. Typically, we bottom about 15% below. So clearly, COVID exacerbated the normal destocking that happens at the bottom of the cycle. If you look at where we are today, we're right back to about trend line growth from the most recent SIA data. Typically, cycles peak about 10 to 15% above trend. On a seasonal basis, we really don't get there until at least the middle of next year, if not the back half of next year. So we do believe that this cycle continues to have legs at least into the back half of next year. But one thing that I always stress with public investors and public management teams is while we like to consider ourselves to be the biggest bulls on semiconductors structurally, none of our structural thesis would argue that this industry is less cyclical. In fact, if anything, we think cycles might actually become a little bit more pronounced than they've historically been over the last 15 to 20 years. And really the reason for that is what drives cycles is inventory builds at customers. And the reason why customers build inventory is one of two reasons: either future expectation they can't get what they want, or future expectation that what they want is going to cost more. If our structural thesis is right and supply growth is structurally slowing and semis are recapturing some pricing power, you automatically incentivize end customers to build inventory in a way that they really haven't over the last 20 years. In fact, if you look at long-term inventory trends, back prior to 2000, if you looked at inventory sitting on semi balance sheets as a percent of total tech inventory, it was around 10 to 12%. During the period of time where semis were flush with capacity and had no pricing power, end customers actually forced the inventory back on semis in a very large way, such that by 2015, 16, 17, that number had grown to about 25%. If pricing power returns to semis, it's our view that customers are going to hold structurally more inventory. And as they do that, unfortunately, in these upturns, we're going to be building capacity to a demand curve that's more inflated than usual. When supply begins to accelerate and customers no longer feel like cyclically they have to build inventory, you're going to see a step function down in demand. And that's what causes the oversupply, which we expect to see in 2023. And with that, Falon, I'll turn it back to you and to Dan.
Perfect. Well, thanks for putting a lot on the table there with your opening remarks. And one thing I wanted to that caught my eye, caught my ear certainly was the 1 trillion market in about 10 years. So, you know, that definitely caught my ear. So, Dan, let me turn to you, Dan Hutchinson, and get your views on where we are in terms of the industry and market.
Thanks. Thanks again. It's certainly, like John said, it's an honor to be here and be with such distinguished speakers, as well as the SIA, to be asked to do that. Great presentation, John. If you include the hyper verticals, it'll actually hit 1 trillion sooner. The Apples and those guys. So
All right.
it's great. We can kind of race when the trillion comes, but it's coming fast. So anyway, what I want to talk about today is, Fallon, I've been doing some work on kind of the policy here more recent. And so Fallon asked me to kind of do that as opposed to just do a data dump. So, and this is just, how we've come over since the 60s, we've just the Americas lost share to foreign countries as we gone into that Death Valley slide there. So next slide. So, but the opportunities are amazing. And when you start to look at the opportunities in terms of direct identifiable markets that you can go at, I mean, in semiconductors, there are too many we could spend all day. And then if you go up into the macro side, you've got the national security advantages of AI everywhere, COVID. The point John was making about AI is really exciting. I don't know how many people know this, but every door when you go into a store now has an AI system in it that is there for safety to make sure that a toddler or a dog doesn't get crushed by the doors. So it is becoming pervasive very quickly. And then you dig down into the equipment and materials, and there's tons of innovation that's happening there. So it really is an innovation engine. Next slide. And when you look at just within the semiconductors themselves, whether it's DRAM or NAND, or logic, analog, and power, or LAP, as I sometimes call it, which is really the SoC market now becoming system in a package. There's just so many technologies to work on and to create value with that there's really no end there. And I agree with John 100%. 300 millimeter really, and the productivity evolution really slowed the industry down. That's over. And now we're seeing the technology really drive the opportunities because it's the technology that brings the value. Productivity just lowers costs. So next slide. And more recently, just real quickly, if you look at our supply demand heat map, this is all driven by algorithms that we bring into our systems every week. A lot of the glut are the shortages behind us, and there's a glut in DRAMs, and that's been there since August. But and there's also been areas where, like the more foundry got into a little bit of a glut. More foundry, more, the 200 millimeter and less smaller wafers. That's been pretty tight, and it's done really well. But most of those areas are out of shortage. Even in auto, more recently, we've seen it become more balanced. The problem in auto, though, is simply that there's all these little spot shortages where you can't ship one part. As the supply chain head of Volkswagen was saying the other day, he said, a 10-cent chip cost them $60,000 in terms of loss opportunity. So it really is an odd kind of shortage that we're seeing, where at least things are back in balance and the capacity's caught up. Next slide. So turning back to the long-term picture, if you go back, all the way into the 60s, which is as far back as our data goes, North America had over 90% share. That began to drop because the Justice Department, again, the government's the bad guys here, but the Justice Department chose to force Bell Labs to give away its IP for free, to license it. And so you see the rise of Europe and Japan. Because Japan had the lowest manufacturing costs, we saw the same kind of picture that we see today in China and South Korea and Taiwan, through the 90s, really driving Japan up. The US did respond aggressively in the 90s. The government funded Semitech, it helped the SRC. lots of really great programs that came through the impetus of the SIA. And we did see some share gains in the 90s going back to the 2000s. But then, things really began to slip after that. And you can see the orange line down there is China on the rise now. And China's is essentially about the same size last year as we were in terms of aerial manufacturing of wafers. Of course, a lot of Chinese manufacturing is American companies producing there, European companies producing there, Korean companies producing there, Taiwanese, but it's still, it's up there. So next slide. And then the other thing about wafer fabs, John sort of touched on this. They're essentially, and Fallon, I think you hit on it too, they're essentially natural monopolies, because what happens is once you build a fab, they're really expensive at $20 billion for a 3 nanometer fab today. But what's really interesting is that when you go to do the upgrade to 2 nanometer, it only costs you a fraction of that, only about 7 billion. And so this is how these fabs move overseas, and then they stay overseas because of this phenomenon, and that ratio is still there, was there 20, 30 years ago. And so you've seen this instance where if the fab's there, it gets upgraded, it stays, otherwise it moves. And then when you get into the other big issue that hurts us a lot is whenever you have a construction delay. If you have a construction delay, it costs you $11 million for every day of that delay. So if you have any kind of things like, poor access to capital or local permitting slowing or sales taxes, all those sort of things, they actually drove manufacturing offshore. Next slide. And then, this is my, people love this chart because it's the Pac-Man chart. That's what they called it. And that's why Pac-Man's there. But anyway, what you see is since 2001, the 130 nanometer, there's been a consumption of semiconductor companies to the day where you just see 3 in the logic space and you see 4 left in the leading edge of the NAND DRAM space. And there we're being a little liberal with the numbers. The 5N node is really driven by density, not just nanometers. So, but what you can see is very few companies, to what John was saying, can afford the R&D of being in the manufacturing space. How did that happen? Well, the big thing that made the foundry possible is that when EDA came, it broke that design fab coupling. So you no longer had to have a fab to make a semiconductor. You just had to design it. And EDA did that. And then there were silicon shield incentives that came out of Asia that really shifted manufacturing to Asia. And that came because as the US recognized China in a defensive policy against Russia, the Taiwan, South Korea needed to really protect themselves. And so one of the ways they figured was as if they made America semiconductors, we'd have to protect them. And then, of course, there was a phobia against CapEx and high capital investment industries in the US. So the investors had a phobia against fabs. And then, of course, there was a whole phobia in the US against industrial policy in the 80s and 90s that really favored the silicon shield region's growth. And then finally, the other thing was that the US began to stop giving away university education for free. And foreign STEM students came here, and they had a huge advantage because they paid more than the local students at U.S. universities. So that we began to develop their infrastructure, their human infrastructure, with our people. Next slide. So, and then more recently, we've got this corporate tax. We talked a little bit about it in the pre-briefing. We've been tracking that. VSI has an index that we publish every week of semiconductor companies and the different subsegments. And one of the things we've been doing is since the beginning of the year when they started talking about raising corporate taxes, a week ago, there was a 15-point percentage point gap between US and non-US companies. As of last week, when you had all of the uproar in China, that narrowed to about 13 points. So they did come back home to America for a couple points. But the money has been avoiding America in fear of just simply the earnings hit to higher corporate taxes. So, as much as we're trying to favor U.S. semiconductor manufacturing, we're also shooting ourselves in the foot with that. So next slide. So finally, when I've watched what the SIA has done on policies, and they're really fantastic. I'm kind of echoing what they're saying and trying to emphasize them a little more. Like, for example, one of the big things that we could do that wouldn't cost much is just a single federal construction permitting process for manufacturing. The hardest part is putting manufacturing anywhere you put it. All of a sudden, you're dealing with the local fire department that's never seen, the kind of gases we deal with or the safety issues we have, and so they're always coming up. In fact, the reason why you see Arizona doing so well is Intel worked with Arizona so well, really well over the years too. It's actually the lowest cost place to build a fab in the United States today. The other one is to bolster the public-private partnerships, like what we've done in Albany, what we did with the SRC, what we did historically with Semitech. IMEC is a great example of how it can be done and how it can be made even profitable. And then there's the link to U.S. leadership. We have a technology leadership in semiconductors, as Fallon pointed out. We also have a leadership in our universities. It's really sad to see that we're educating the workforce for our foreign competitors, semiconductor industry, and then finally keep taxes low. If you come back to the leadership in the universities, I think some of the things that I've recommended that we could do specifically is do things like, if you got a STEM college degree and you're working in the semiconductor industry, why can't you make the loan payments to that tax deductible so they get a tax incentive for going into the semiconductor industry? If a foreign student gets an advanced degree in STEM, this is something Craig Barrett suggested decades ago, and it's never happened. And that is he was the former CEO of Intel. If you get a STEM degree, you automatically get a green card, provided you go to work in the semiconductor industry. There's all those sorts of things that we can do. And it's absolutely essential we do this in the K through 12 and keep kids in STEM. The joke is if you get a degree in mechanical engineering, you might build a fab someday. If you get a degree in electrical engineering, you might design a chip someday. If you get a degree in liberal arts, well, you're going to be asking, do you want fries with that? So thank you, Fallon. Next slide. And that's there.
Thanks, Dan. Appreciate that. No, a lot of good stuff to unpack in the Q&A. But I want to get to you, Dale Ford of ECIA. I know we've been talking ever since the beginning of the pandemic, checking in about every 6 months or so, and you guys do a lot of great stuff in terms of surveys and sort of keep an eye, sort of focus on where we are. So I want to turn to you to get your thoughts on where we've been and where do you think we're going to go over the next year or so.
Great. Thank you, Fallon. I appreciate the chance to join Dan and John here, share some of our research today. Let me jump right in here. On to the next slide. We do follow more than semiconductors in our research. We follow everything from passive components, electromechanical components, and semiconductors. Here, just showing the growth rate that we've seen across these major categories in the electronics components industry, breaking up both worldwide growth and America's revenue growth. It's interesting to note, and there may be some element of the law of large numbers in place here, but first half over first half, year to date in 2021, we see that strong growth worldwide and in the Americas for semiconductors has been noted, well over 20% growth half over half, but it's still behind what we've seen in capacitors and even inductors. So we see a surge in demand. And this is not a unique element to semiconductors. Certainly, this is being driven across multiple sectors and shows a very robust, healthy environment for demand here. Next slide. Now, there's good news and bad news, I would say, on this. This is data is published by SIA, the research conducted by WSTS, and we show both the quarter over quarter and the annualized growth rate here. And what we searched to up to the latest data in July was we've now reached our highest peak in over a decade in terms of quarter over quarter growth. You have to go back to 2010 to see a growth rate as high as where we're at now. So great news, and that's driving a very strong upward cycle in the annualized growth rate. The one item of concern is that actually the last data point in July showed a slight drop in the 312 growth rate. Now, it's only one data point and it's only 1 month, but it does beg the question, is this a pause or a peak? Is this simply something we're pausing because we had such a strong surge in the second half of 2020 and we're going to see a little bit of a pause in the 312 growth rate? Or is this a peak where we roll over? Right now, our opinion is that we are going to continue to see strong, robust growth, that this has legs that will continue on through 2022. Our top level, not official forecast, but forecast would be that by the end of this year, we expect we'll see somewhere between 22 and 24% growth on an annual basis, and that this will continue into next year, and that anything happening in the 312 would be a positive growth. We've seen that in other cycles where that's taken place, but we see that this will be sustained with the key demand drivers and the technology drivers that Dan and John have discussed previously. Next. This is comparing all the various cycles in the semiconductor industry throughout the history. What I've done is I've started all of them at the same point in time when the cycle started moving upward. This is the annualized growth cycle, and also rationalized all of these to start at 0. Now, we do see some of the earlier cycles in the early days of the semiconductor industry that had some very high growth rates and extended cycles. Typically, a cycle now lasts about 4 years. If you look at the more recent cycles, the current cycle is in the dark black line here. We see that we're in a very strong cycle. We're outperforming the most cycles in recent history, with the one exception of the cycle in 2009, which had a strong up and a strong down. It lasted a much shorter period of time in that cycle. But in terms of performance and just on a data basis, this is a very strong, solid cyclical growth period that we're moving into. We're above most other cycles where we would be at this point, and we're showing an upward trend still at this point, whereas many other cycles were leveling off or even declining at this point in their cycle. So this is a robust, healthy cycle that we're in. Next. We conduct surveys of our going out, looking at participants across the supply chain, whether they're manufacturers, distributors, or manufacturer reps. And we capture the sentiment in terms of their expectations for growth in the current month compared to the prior month, and looking at the next month compared to the current month. And I've charted this onto an index, just showing where we stand. Anything above 100 shows an overall sentiment and expectation of growth. And we see the huge peak, not a surprise here, that we saw in the early part of this year. And growth has come down in terms of expectations, again, somewhat aligned with what we've seen. The good news is that we see a stabilizing in terms of sentiment in recent months. The dashed line shows the expectation looking out towards October. And so we see a stabilization in terms of growth expectations that continues through October. And that's an encouraging sign in terms of where we stand in terms of sales in the North America. Next. And looking even longer, this is showing our expectations out into the next quarter. So looking through the fourth quarter, this shows what the expectations were in the third quarter and what they are now looking towards the fourth quarter. And still very strong expectations of exceptional growth. If we look at semiconductors, we see that those who are expecting over 5% in the fourth quarter, still, roughly nearly 25%. And if we're looking at all those, looking at least above 3%, we're looking at, well over a third. So a very strong outlook and expectation for growth all the way through the end of this year. Next. And then this is just looking at the end market demand, very similar to the month-to-month profile that we saw in the component outlook. Again, somewhat of a stabilizing trend, those who are expecting growth compared to those who are expecting a decline. There's never been more than just a handful, well, typically 5 to 8% that have expected a decline, but those who are expecting growth has come down. So more stability in terms of expectations for a stable environment in the marketplace. Next. Now let's look at just briefly at the drivers of demand. You know, we're very fortunate. We are in an industry, if you look at this data by McKinsey, that I know that John argued that we've lagged behind in terms of the industry compared to global GDP, but in terms of economic profit by industry and the valuations, you know, their argument was here, the best are getting better and the worst are getting worse. And semiconductor sits at the top of the heap here in terms of both the valuation, the current valuation, the long-term outlook here. And so, you know, and then as we work with technology hardware, again, another top performer. So, you know, we sit ahead of pharmaceuticals, we sit ahead of software, you know, telecommunications. It rolls off very quickly. So semiconductors, in terms of the profits that they drive and the performance in the financial markets, have been a strong performer, and the expectation is they will continue to be a strong performer. Next. And very much aligned with what John was saying here, data creation, communication, storage, and analysis will be important long-term drivers that's been accelerated as we go into this fourth industrial revolution, as we've talked about. And we see this expanding digitization in every area. And as he noted, the CEO of Cadence noting less than 2% to this point of all this data we're generating has been analyzed. You know, 90% of all data in history was generated in the last 2 years. So we see this explosion in data and incredible opportunities for analysis and action on that data. And I still think we're very much driven by what I call the technology triumvirate: the cloud, IoT, and 5G. I've done entire presentations on that, but I'll just leave that there for now. Next. This is looking at just the growth drivers for this year as we surveyed the major distributors in the US, their expectations for what would drive growth. This is a rating from 0 to 10. Electric vehicles stood out just ahead of 5G in terms of expectations for the year, followed by IoT. So very much aligned, with the exception of electric vehicles for that prior chart. And then renewable and green energy technologies. Those are seen as near-term key drivers for demand in the marketplace. Next. So continuing on, Dan, Falon mentioned briefly the impact of COVID on the marketplace. We are doing surveys. This is just a couple of slides on this. There's much more in-depth work we've done here, but looking at when companies expected their employees to return to the workforce. Now, if we looked at this back in August when we did this survey, we're almost finishing a second survey on this. We saw that just over, roughly 25% of companies had 100% of the workforce back in the office. But at the same time, you had nearly 18% of companies that nobody was back in the office. Looking forward, the expectation was that this was going to transition fairly quickly. By the time we reached September to October, over 50%, roughly 50% or more, were expecting 100% of their workforce back in the office. And so we saw a transition there. Now, this took place before the concerns about the Delta variant, the Mu variant, and other things. So that's why we're doing another survey, because the expectation is that companies are going to be more conservative in how quickly they are having their employees return back to the workplace. Next. And many new policies coming into play. I won't go down every one of these areas, but new company policies coming into place with regard to travel and interaction, with regard to health screenings, vaccinations, and new employee orientation and training, all these areas, not exactly the same in all areas. And again, this will continue to evolve as companies work to adopt their practices and how they respond to the ongoing challenges, which don't see any near-term solution to it, of COVID. Next. Now looking at the supply chain overall, many supply chain disruptors here. If you go down the line, this is just a quick list, but one has really emerged out to the front. If we go to the next slide here, we see that, the lead times that we're experiencing now are just shattering records. If we look at semiconductors, the lead times for processors, really microcontrollers, the lead time for discrete components, it's incredible, the lead times that we're now driving here into this space. And every one of these categories, whether it's analog components or logic components, in all of these areas, we've completely shattered records for lead times, and you don't see any rollover in any of these areas. And so this is creating a monumental challenge for players up and down the supply chain. Next. And you can see, you know, this is a bit admirable, really, if you look at this on a worldwide basis. If you look at unit shipments, you know, you look at the increase in discrete shipments, we're up 34% from what unit shipments were at the start of the recovery, up 8% from the previous peak. Analog ICs up 40% from the start of the recovery. Logic ICs up nearly 50% from the start of the recovery, and 27% from their previous peak. So, I mean, the semiconductor industry really should kind of pat itself on the back for how it's responded to the demand that has come into place. I mean, it's phenomenal. Falon showed the chart. We're running at these run rates that are just incredible, but we still can't keep up with the demand. So certainly we're on a very challenging profile as suppliers to the industry in terms of keeping up with this. Next. And so this is, you know, we talk about putting in place new fabs and the required investments. You know, it's interesting, the cycles and what we see here. You know, we are in a bit of a volatile industry. You look at the ups and the downs across these various cycles, and we're a fairly volatile industry. And the greater the volatility, the greater the risk, the greater the risk, the greater expected return on investment into the industry. So we talk about building fabs, we talk about where they're being located, but all of this plays into these investment decisions and plays into the role the governments play in facilitating and enabling and encouraging investments to respond to this challenge that we're facing here. Next. So to wrap up, just looking right now, the transportation disruption is by far and away the #1 issue facing the supply chains of all types, not just semiconductors, but semiconductors certainly are caught into this incredible trap. We see that, you know, transportation disruptions have been a strong concern, but they've emerged to be far ahead of any other issue related to the supply chain. And on the next slide, we see how this is played out. This is just a snapshot going out. You can look at the ships sitting outside of ports in Shenzhen. How many of these were cargo ships? Well, they're dominated by cargo ships. You know, we talk about outside the ports in Los Angeles and Long Beach, and we talk about how it's roughly 60 ships sitting out there in the harbor waiting to be able to come in. Typically, it's been one ship in the past that would sit out there waiting in the harbor, waiting to come in. So whether it's in China or in the US, the harbors are just overwhelmed. Next. And so we see pressure at every stage. You know, yeah, most semiconductors don't go by ship, but even if you're talking air freight, yeah, we see cargo going well above, but much of this is also shipped on commercial flights, and the flights have not returned internationally, especially. And so we see constraints on sea shipments, air shipments, railroad, trucking, ports, storage, every stage. And I don't see any solutions that are being offered here to get us out of this jam, this log jam that we're in. And this is an ongoing crisis that continues with no end in sight. Next. So with that, happy news. We'll turn it over and wrap up and look at the conversation and the questions here.
Hey, thanks, Dale, and thank all three of you. I know we're at the top of the hour, but you wouldn't mind just taking about 10 minutes or so extra. Would love to try to at least, you know, can't go through all the Q&A that we got from the audience, and appreciate all the information, all the questions that have been sent in, but I want to just throw out a few questions to sort of cover some other bases, if you wouldn't mind. And for all three of you, one, want to talk a little bit more about what, Dale, you hit upon, global supply chains and the semiconductor ecosystem, and to get to the question of, what do you think can be done to make the semiconductor industry supply chain more resilient going forward? The industry is, going to still be relying on global supply chains. I believe, in the future, that's sort of not going to change. But the question is, how do we make them more resilient for the next time we have a major disruption, such as a pandemic? So that's question number two. Question number one. Question number two, and I think, Dan, you had mentioned, alluded to China in terms of their efforts to grow their industry. It's been about 7 years since they implemented their policies to grow their domestic semiconductor industry. I guess the question is, where is China in its ability to become a major player? They spent a lot of money over the past 7 years. What do they have to show for it? And then lastly, I guess a question more philosophical than anything else, but would love to get your thoughts on this market outlook. So we've seen, I think, with COVID, sort of a need, a necessity to rely more on semiconductors, and that's sort of been prompted by sort of this sort of crisis situation, right? Yet, as you mentioned, Dale and John and Dan, the 5G, AI, the ability of a technology these days is so great, but it may not be taking advantage of as well as it perhaps could be. And I was just wondering, what do you think could help spur more adaptation of various technologies that semiconductor industry is enabling? So one or any of those. John, maybe if you want to maybe take the first question about global supply chains and how that could be sort of how we could weather the storm going forward next time.
Yeah, from my perspective, listen, you're only as strong as your weakest link, and this isn't the first time that we've dealt with weak links. I think a good analogy to think about is the Fukushima earthquake in Japan. We all of a sudden overnight had to become experts on BT resin and who was supplying BT resin, because printed circuit boards became sort of the bottleneck. And I think if you're thinking about what policymakers are trying to solve, which is, supply chain security and lessening dependence on China, the only way you can really do that is redundancy and really regionalization of the supply chain, unfortunately. Now, our view is that if COVID reinforced the idea that supply chains need to be a little bit more redundant, a little bit more regional, I actually think that's really good for one of the big trends we talk about in semis, which is Industrial 4.0. Because redundancy and regionalization means cost. And to take cost out of the system, you're going to increase automation and intelligence, and that plays right into kind of our industrial thesis. The one point that I keep trying to make, and I'm sure everybody on this call has probably talked to more politicians in the last 2 years than they've had the previous 20, given all the focus this has had. But I do think it's a little bit short-sighted to believe that if you build fabs in the US, that somehow that's all it takes to secure your supply chain. Because if you still have to ship those wafers back over to China to be tested, packaged, and assembled, you really haven't secured the supply chain all that much. And so I think, while what's happening with the CHIPS Act is clearly a great start, we need to have a more comprehensive policy across the entire supply chain if we're really going to secure it and make it a little bit more redundant and more regional.
No, that's a great point. Dale, Dan, any thoughts on securing the supply chain?
Yeah,
I think
go ahead, Dan.
No, I was just going to say yeah, we need real intelligence as opposed to artificial intelligence on the supply chain. And because we've had these before. I mean, I was looking at Dale's chart and you reminded me of the capacitor shortage in 2018, and the car companies couldn't ship because they didn't have capacitors. And then we got into this shortage. It was like, I thought you guys learned the last time.
Mm-hmm. Dale?
Yeah. There's a couple things I'd point out. One, John's right. I mean, the CHIPS Act, $50 billion, great. The rest of the world is not standing still waiting for what the US is going to do. You've got Europe, you've got Korea. They're talking $100 billion types of investments in fabs. So $50 billion isn't quite going to cut it. But there's a couple of answers here. One, I do think there is some regionalization issues that are in place. There's some proposals out there. Tom Linton, who used to be the chief supply chain officer at Flex, he's proposed a Pan-American type of supply chain that could be set up that could drive many advantages. That would take many years. That's a long-term goal. but I think it merits consideration and exploration there. The other thing, and I have to mention this, is ECIA, we represent the authorized channel in the supply chain. And our argument is that distributors have played and will continue to play a really important role in helping companies manage the supply demand pictures they deal with. And the automotive industry, one of their big mistakes has been that earlier they disengaged from the distribution industry, and then two, they canceled all their supply contracts at the bottom of the cycle for chips. Then they tried to get back in line. So, you know, if they're dealing with people who are experts in supply chain management, there's benefits that will be derived up and down.
Gotcha. Yeah. China. Let's do a quick round there. Dan, what's your thoughts on where China is in terms of its development of its indigenous industry?
Well, it's certainly not meeting its goals, and but it is making progress. And you know, China's going to do what China's going to do. You know, we have to stay ahead of them. It's what we do. And you know, as much as I like the $50 billion CHIPS Act, you know, semiconductor technology does not stand still. So it's got to be, you have to put things in place like building the human infrastructure, you know, continual sort of, you know, corporate tax advantage, those sorts of things that give us a long-term run on it, as opposed to, you know, just a one-time hit. You know, it works. And then you see what happened in Scotland when there was a huge manufacturing infrastructure up there in the 80s, and it just disappeared because the government stopped funding it. So, you know, you come back to China on that aspect of it, you know, they're actually scaling back now because they've had so much corruption in their attempt to become self-sufficient. And so, you know, we are seeing some really surprising, like the YMTC new flash memory. That's, you know, our guys in Ottawa did an analysis of that, tore the whole chip down, were really impressed with the technology, said it was as good as anything that comes out of Samsung or Micron on their first review. So they're making those advantages. When it comes to logic, they're still way behind.
Yeah. John and then Dale, any thoughts on China and its efforts?
No, I mean, I'll kind of echo what Dan said. I'd like to say that China's been 3 to 5 years away from getting semis right for the last 20 years. So they have missed their internal targets. But there's sort of two things I'd bring up. There's an extremely vibrant private company ecosystem in China today of semiconductors. And one of the things I mentioned earlier was all the consolidation that went on in the semiconductor space from 2010 to 2020. The advent of AI is changing that globally, but China has clearly invested in these startups, and I think that's an important sort of dynamic. One of the things that I'm looking at to see if China accelerates this move is, I think one of the things that's actually hurt China is they haven't centralized their effort in a single region. I think both Dan and Dale both talked about, you know, the benefits of having infrastructure in one location. In China, they've sort of been farming these out to different provinces. And I think that's diluted their effort. If they get their act together and actually look at a central location to focus all this effort, I'd have a little bit more confidence in them getting it right in a shorter time period.
I'd mention two things. There was an excellent article. I think China in the current environment will never be able to catch up. Excellent article in the Wall Street Journal that ASML is the only company that supplies the critical piece of equipment that's needed for the most advanced technologies in DPUV. It was developed in collaboration with other, you know, governments and companies in the West. And the export controls on that equipment will mean that China could never access that equipment unless something dramatic changes there. And that's the only source. So they're a Dutch company, and as long as the US and Europe stay on the same page there, China's got a significant roadblock. And I guess the only way they get through that roadblock is what I would say would be a different type of acquisition, is if China made a move on Taiwan.
Wow, yeah, that's a whole that's a webinar. That's a whole other webinar topic.
But, they are developing their own DPUV, but they're light years away from being able to achieve anything.
Yeah, no, yeah. And there is one of our reports we did last spring on global supply chain issues in semiconductor industry. There was a whole sort of subsegment on the development of lithography and how many years it took in collaboration. It's like not an overnight type of thing you can develop, I suppose. So
Yeah.
I wanted to get to this question, and I know we're getting short on time, but I did want to get about this question because it gets to the question of how we all sort of didn't really anticipate how much more important semiconductors would be because of this pandemic, because of the pandemic and sort of the need for it. And I would argue that, again, there's a lot of these technologies, 5G, AI, where we talk about just the potential for what they can do. And I'm wondering how do we as a society can accelerate that, I suppose, without actually having another crisis, to take advantage of these technologies, because you could argue that they're there, just like telecommunication or teleconferencing equipment has been here for years, but hasn't been really taken advantage of until we have a crisis or so. Dale, any thoughts on that in terms of going forward, like how to better take advantage of the technologies that are presently available?
I think that we're going to feel significant pressure from this aspect of the need to continue to enable growth in productivity. If you look at productivity, the economists will point out that labor and the supply of labor is critical in that, or at least it has been. Now, technology plays a role in that, and we see already in Japan how their economy was impacted by their aging population. The same dynamic is happening around the world, with the exception of Africa and Latin America. And our economies are going to face significant economic challenges with their aging populations. We know that. And I believe that technology does offer a long-term answer to the productivity that's necessary to continue to drive the economic growth that we need in the future. And policymakers are going to have to be looking at that. And I think there's going to have to be coordinated initiatives and investments to exploiting the technologies to enable ongoing productivity growth. Because if we simply rely on the labor supply, the US is already headed towards a zero, a balance between the numbers of deaths and the numbers of births each year. The CDC, the chart, boom, right down to zero. And so if that's what we're seeing, we have to do something, and technology, I believe, is the answer.
Yeah,
I think that's no, the thing of it is COVID, as bad as it was, it did us a great service, because, they say it takes someone to get killed to get a traffic light somewhere. And that's what COVID is that you remember last year at this same webinar, I was predicting that we wouldn't go into a downturn because of COVID, that it was going to energize our industry, that we would decouple from the macroeconomy. And that's what happened. And it's amazing because, doctors, they fought being able, and the insurance companies fought being able to do video visits. And COVID, our technology made it possible, but it also got adopted. And I think the problem is often not that we haven't developed the technology, it's getting the world to change the way it does things and adopt it. You look at the vaccine development, it was massively accelerated by the use of AI and just the scale of compute technology that we've developed at an industry. And it's something that the pharmaceutical industry, had been doing things more on a sort of a randomized thing and not looking at it as analytically. So things like that really changed when you're forced with a real deadline and an emergency. That's what drives things. And for me, I hope we don't go back to business as usual, that to realize that there's so much our industry has to offer to the rest of the world, that the rest of the world doesn't, just stop looking at us and just go back to doing the way the things they're doing them, because there's just so much we can change.
Yeah, I mean, from my perspective, I echo what Dan said. COVID clearly codified and accelerated underlying technology trends that were there. I guess the reason why I'm so optimistic, through cycles for this industry is something I harped upon on my presentation, which is we're solving a major economic problem around data analytics with the move to AI. And I do believe that as the cost of analyzing data comes down, that's going to allow things to become much more pervasive. And one of the things that I fight in the public markets is there's clearly a view that everything's going to the public cloud. And while I'm very bullish on the cloud, I remind people that the Fortune 500 IT spending ain't going away. Mm-hmm. And as AI needs to be implemented in Main Street America to keep companies competitive, I think we're going to see a resurgence of sort of IT spending on-prem. And remember, since the tech bubble burst in 2000, most corporations have been spending IT for only really two things: stay compliant and cut costs. They really haven't been spending on building out new markets, new revenue streams, staying competitive. And what I really see is all these Fortune 500 companies claim they have a data strategy, but when you get down into the detail, they're really just scratching the surface. And so I think over the next 3 to 5+ years, whether or not you do data analytics well is going to be the differentiation between succeeding and failing across multiple businesses. And so I don't really look at a tops-down driver for technology adoption. I'm more bullish because I see a ton of bottoms-up drivers as AI helps to solve this sort of economic issue of data analytics.
Yeah, and I suppose that is adopted more robustly, then I guess we'll get to 1 trillion, maybe even quicker than in 10 years. So that's the number to keep in mind. So we are definitely well past the hour, and I want to thank all 3 of you for taking the extra time and for participating in today's webinar. I suppose we could talk endlessly about the semiconductor industry and the market and where we're going, and it's obviously a very interesting time, to use a euphemism, for being in the semiconductor industry. So John Pitzer, Credit Suisse, Dan Hutchinson of VLSI Research, and Dale Ford of ECIA, thank you so much. And I want to thank the audience for all your questions. Apologies we couldn't get to all of them, but we'll see you next time. Thank you very much.
Thank you.
You guys.
Welcome.